Extreme market volatility tests every investor, and few assets show that stress better than the recent history of Solana. At its peak, a single SOL coin traded for nearly $295. Today, you can pick one up for around $71. This chart shows the severity of the drawdown, tracking a 76% drop from that all-time high down to our current baseline. For any value investor looking at those numbers, you have to ask a simple question. Is this asset broken, or are we looking at a massive discount? Here is the conflicting data point. Despite that massive bleed out in price, Solana is still holding its ground as a top 10 cryptocurrency by total market capitalization, bolstered in part by its growing institutional presence through live spot ETFs. Retaining that kind of market dominance and institutional interest after a 76% crash means the underlying network possesses utility that prevents a total collapse. To understand that utility, we have to look at what the network actually is. Solana operates as a layer 1 blockchain. That means it runs its own independent network. It does not rely on being built on top of the established Ethereum ecosystem to function. When Anatoly Yakovenko launched the project in 2020, the goal was focused: maximize transaction speed while keeping user costs as close to zero as possible. This map visualizes the result of that architecture. The network processes thousands of transactions every single second, and it does it with near zero fees. That raw speed is what developers need to host high-frequency decentralized finance apps, process NFT trades, and build real-world asset projects. Prioritizing isolated transaction speed over Ethereum's deep liquidity was a specific trade-off, and the trade-off worked perfectly, resulting in one of the most active, bustling developer ecosystems in the entire crypto industry today. But strong technology doesn't automatically equal a rising coin price. For that, we have to shift focus to its financial structure, or tokenomics. Right now, there is a circulating supply of roughly 580 million SOL tokens on the market. The critical flaw for investors looking for scarcity is that there is absolutely no hard cap on how many tokens can exist. Because there is no hard cap and no burn mechanism, the network is inflationary. However, as a mitigation strategy, the code forces the inflation rate to decrease by 15% yearly. This downward curve will eventually level out, stabilizing near a 1.5% long-term target. But even with a slowing rate, continuous token expansion dilutes the value held by existing investors over time. Investing here means fighting a constant, long-term inflationary drag on the price, regardless of how fast the underlying technology runs. If you move past the long-term tokenomics and look at the immediate price action, the picture remains challenging for momentum traders. Sitting at that $71 mark places the asset right in the middle of a cautious market sentiment. Look across multiple timeframes, and the current chart reality shows bearish technicals dominating the setup. This candlestick chart highlights the critical ceiling. Price is struggling against heavy resistance marked exactly at $72.50. A clean break above this opens a runway towards $76. Failing to break this line confirms ongoing downward momentum, trapping the price under heavy pressure. Breaking through resistance this heavy is going to require a broader macroeconomic catalyst. Even with spot ETFs already live, minor internal network updates will not be enough to shift this trend. Without a major macro shift in the market, prevailing bearish gravity will likely force a rejection at that ceiling. That makes immediate swing trades right now risky. Taking all the data into account, the final verdict comes down to a few core factors. First, there are two major reasons to be bullish. You have a project running one of the fastest and cheapest layer 1 networks in crypto, paired with the growing institutional exposure we've seen via those live spot ETFs. On the flip side, there are two distinct reasons to be cautious before investing. This scorecard lays out the danger. You are dealing with an uncapped, inflationary supply, combined with a 76% drawdown and charts that lean bearish. This makes the ideal investor for this asset someone who is patient. You have to be a long-term believer in the technological fundamentals who can weather ongoing token dilution. Ultimately, the project is operationally sound, but momentum poor. It represents a trade-off between network utility and structural scarcity. If you decide the utility outweighs the inflation, you can execute trades on platforms like Binance and Coinbase, or swap directly on the Jupiter VX. Keep in mind, this analysis is not financial advice. You must always conduct your own independent research before risking your capital. If you found this helpful, smash that like button, subscribe for daily crypto breakdowns, and share this with someone who needs to see it. Now, the final decision is in your hands. Drop a comment below and let us know. Are you personally bullish or bearish on Solana right now?